We're hearing that Credit Suisse is tightening some of those hedge fund limits amid the Archegos fallout. We are lucky that we have the reporter on this story, Eric Schatzker, with us. And Eric, it sort of seems like, yes, this should be the appropriate response. Am I right?
Well, let's walk through what's happening very quickly. Credit Suisse is the bank that lost the most, right, in the Archegos blow-up, $4.7 billion. We found that out just yesterday. They dumped a number of senior executives, including the head of the investment bank and the head of risk. But it was clear that more was to come. And this is the first step of what's to come. Credit Suisse is tightening the financing requirements for family offices and hedge funds that use swap agreements. I'm not going to get into the details too much because it is a little weedy, but they're going to what's called dynamic margining from static margining. And the net result of that is the family offices and hedge funds that use swap agreements instead of standard prime brokerage agreements may find themselves posting more collateral to take positions. And as those positions evolve in terms of their underlying risk, concentration, and volatility, and the trades that they undertake may end up being less profitable.
Eric, you say it's the first step. How are the hedge funds, the family offices reacting to this? Is it something that they saw coming? Is it something that they see is going to be more painful, going to be an issue for customer loyalty over Credit Suisse?
Caroline, they're absolutely delighted. Of course they're not. This is terrible news for a multi-strategy hedge fund or a quant shop that uses swaps to gain leverage. Now, the big difference, I should add, between these multi-strat funds or the quant shops, is that their portfolios are nowhere near as concentrated as Bill Wong's was at Archegos. But nonetheless, they're now paying the price because of the loss at Credit Suisse, the loss at Nomura, the loss at Mitsubishi UFJ. You know there's going to be pushback, but when the board at Credit Suisse, we have to assume this comes from the board level, is saying to management, you must do this, there is no alternative. Of course, those hedge funds and family offices might go to another dealer, but they might find that industry standards, are tightening up across the industry.
Well, Eric,
There's nowhere to hide.
Well, Eric, that's where I want to go next here, because I mean, obviously, if you sort of run into this limit at Credit Suisse, you just find another broker who will deal with you. Is this really going to be the trend now? Do you think that there'll be enough, at least of the legit brokers out there, who will now sort of follow these new standards?
It's quite possible, Romain, that Credit Suisse will lose some business, will lose some market share as a result of this. But everybody can see what the cost of inappropriate margin requirements is. In Credit Suisse's case, it's $4.7 billion. And so I would say that, yes, we're probably going to see the street move more toward these dynamic margining requirements for swap agreements, so it's going to affect everybody. And even if you do want to shop around and find somebody else who will take your business, you might encounter similar restrictions.
Yeah.
That said, the very large
All right, guys, as you can see, it's getting a little bit more difficult for the shorts and the edges to get more capital to continue to use that to attack and to do whatever tactics they have in the pockets into shorting AMC stock and other companies as well. So as Credit Suisse lost a ton of money, and the head of investment banks and other have been fired. It seems like the trend will now be for those big banks that are now allowing capital to these hedge funds, to do business, to reduce it. So it means in the case of AMC with less than 25,000 shares. So if you want to continue to attack this thing, first of all, you won't have as much money as you think you may have in the past, because nobody will say, I don't have the money, man. I can't do business with you. I don't want to be in the same position as Credit Suisse. In the meantime, there are no short shares available to use to attack the share price. So seems to me like it's getting towards the end, guys. It may not be as quick as we want it to be, like maybe next week, but we are definitely getting a little bit closer to this thing popping into the direction we are really wanting to pop. All right, so I will continue to hold my shares, guys, and if I can buy more, I will buy. Otherwise, thank you for watching, and I will see you in the next one. Take care. Bye.